Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. We've spent the week wading through, well, a lot of articles, research notes, analyses, and the message seems pretty unified. Global financial instability is really running rampant. But this time, the driver isn't just the usual suspects like inflation or interest rates. It feels like it's pure political risk. We're diving deep into some high-stakes instability across Europe, the U.S., and Asia.
Yeah, it's a lot to take in.
It really is. And it can feel overwhelming, I think. So our goal today is to try and make these big global events feel a bit more actionable, clearer for you.
Exactly. Think of it as a shortcut. We're taking three specific, high-impact political firestorms and breaking them down. Simple concepts, hopefully memorable, so you can clearly see the connections between all this political volatility and, well, the stability of your investments.
That sounds like exactly what's needed right now. So what are the three big themes we're tackling today?
Okay, first up, we're looking at that really dramatic political gamble happening in France. It's caused quite a panic across Eurozone markets.
Right.
Second, we'll pivot to the global bond crisis. This is fundamental. The whole redefinition of the safe asset, why that traditional anchor seems broken.
Okay.
And finally, we'll try to dissect the, frankly, confusing and very high-stakes U.S.-China negotiations and the extreme market volatility they seem to promise.
Okay, let's unpack this. Starting with what the sources are calling maybe the most immediate global risk. France. President Macron just dissolved parliament, called a snap election. For those of us maybe focused elsewhere, why is this move so significant? Why is Europe, panicking?
Well, it's an enormous roll of the dice. Macron was dealing with this long political stalemate, right? So he announced these snap elections, probably hoping to stabilize his centrist agenda. But the market, it's not buying it. The worst-case scenario on the polls suggest it's actually highly possible is that Marine Le Pen's far-right national rally, the RN party, wins an outright majority, or at least a plurality.
And if they win, what happens then? What does that look like?
That forces what the French call cohabitation. You'd have a far-right prime minister running the country's domestic policy, but under the centrist President Macron.
Right. Sort of like divided government here, but maybe more extreme.
Exactly. And the key insight here is that the RN party has historically been very Eurosceptic. So analysts are pretty much universally arguing this would lead to, well, extreme political gridlock in France and guaranteed conflict with the European Union on basically everything, budgets, immigration, you name it.
And the market's reaction to just the possibility of this was immediate. French stocks, especially the big bank stocks, they just tanked on the news.
Probably, yeah.
I think the average investor hears bank stocks dropped and immediately thinks, oh no, are the banks failing? Insolvency, what's the real financial threat here?
That's a really critical distinction. This isn't primarily about banks suddenly going broke. Not at this stage, anyway. This is about capital flight. International funds, they don't wait around for a far-right government to actually get elected. They reduce their exposure immediately to get ahead of the risk. So they sell the easiest things, the most liquid assets like major bank stocks that are tied to the domestic French economy as fast as possible.
So they're selling not because the bank itself is shaky, but because they want less exposure to France overall.
Precisely. They want out of the country, or at least to reduce their stakes significantly. It signals his broad loss of faith in French political stability.
Okay, so if the market's worried about the fundamental structure of France, maybe even whispering about Frexit down the line, what's the single most important number, the key indicator an investor needs to watch right now to gauge how bad this is getting?
You absolutely must watch the France-Germany 10-year bond yield spread. Right now, it's sitting around 85 to 88 basis points. Let's break that down simply.
Yes, please, because basis points can sound a bit technical.
Right. Basis points are just hundredths of a percent. So the bond yield is basically the interest rate France has to pay to borrow money for 10 years.
Yeah.
Now, think of Germany as like the global benchmark for safety. They're the student with the perfect, 850 credit score. Untouchable.
Okay, super safe.
Super safe. France, now facing all this political chaos, is like the student applying for the same loan but suddenly has terrible grades and a really shaky job history.
They look much riskier.
Exactly. So the spread is that extra risk premium, that added interest rate. The market charges France compared to super safe Germany. If that spread widens, it means the market thinks France's credit risk is rising significantly.
And is there a specific level people are watching, a trigger point?
Yes. The consensus across the research we read is that if that spread hits or goes above 100 basis points, meaning France is paying a full percentage point more than Germany to borrow, that's the political red line. That's the point where the European Central Bank, the ECB, might feel forced to step in and try to stabilize things.
But until then.
Until then, that risk premium is just climbing, reflecting pure political fear.
That perfectly links the political action to the market reaction. Okay, now let's shift focus because, well, political chaos isn't just a European thing right now. The sources are highlighting instability right here in the U.S. is fueling this global bond crisis.
Yeah, we have a bit of a perfect storm domestically. As of today, we're still dealing with an ongoing federal government shutdown.
Right.
And at the exact same time, the U.S. Treasury Department has to conduct these massive long-term bond auctions this week, selling 10-year and 30-year issues. They need to borrow a huge amount of money precisely when the political credibility of the U.S. government is, well, at an absolute low point because of the shutdown.
What are the practical consequences of trying to sell debt when your credibility is low? What does that mean?
It's pretty simple, unfortunately. If the rest of the world looks at the U.S. and sees a government that can't even keep itself open, international buyers just demand a higher interest rate, a higher yield to take on that perceived risk.
So they charge us more to borrow.
Exactly. And the Treasury is forced to pay that higher rate, which immediately drives up borrowing costs for, well, every U.S. citizen and company for potentially years to come. It impacts mortgages, corporate loans, everything.
And this isn't just a U.S. problem, is it? The instability seems to be contagious.
Yeah, analysts are noting this instability is kind of bleeding into other developed nations, too. You see it in Japan, where the new prime minister is giving sort of mixed signals on fiscal policy. And back in France, Moody's just issued a credit warning, citing the political risk we just talked about.
So the common thread seems to be that political instability is making government bonds, the things we always thought were safe, less reliable worldwide. The core insight I keep saying in the sources is that the traditional anchor of the portfolio, it's broken.
The anchor is absolutely broken. I mean, for decades, maybe 40 years, the core assumption was that developed country government bonds, U.S. treasuries, German bunds, or French OATs were the safe haven. Stocks crashed, bonds went up, provided stability. Simple. Now, they're often the source of risk because governments are financially strained and, frankly, politically unpredictable.
Okay, so if that old anchor is broken, how do you redesign your safe asset basket? What are the replacement tools? What's considered safe now?
You have to fundamentally change your definition of safety. The prevailing thinking, based on what we're reading, suggests three key pillars for stability in this new volatile environment. First, gold.
Okay, the classic.
Yeah, it's a physical asset. It's entirely independent of any single government's ability or willingness to pay its debts. The more distrust there is in political institutions, the greater the appeal of something, tangible, physical.
Makes sense. What's the second component? Maybe replacing that government debt we used to rely on so heavily.
This one's fascinating. Ultra-high-grade corporate bonds.
Corporate bonds. Safer than government bonds.
In some cases, yes. We're talking about AAA-rated giants. Think Microsoft or Johnson & Johnson. These companies generate massive, reliable cash flows. They're sitting on mountains of cash. Their financial solvency, their ability to pay their debts, is now often seen by sophisticated investors as stronger and more predictable than that of many over-leveraged governments.
Wow. So corporate debt potentially safer than sovereign debt? That really is a major paradigm shift.
It is. It speaks volumes about the state of government finances and political stability.
And the third essential element for this new safe basket?
Cash. Just plain old cash. In a high volatility environment driven by political headlines day to day. Cash gives you necessary defense and flexibility. Preserves your capital, obviously, but crucially, it allows you to capitalize on opportunities when market panic creates massive discounts on good assets.
So cash is defense, but also potential offense later.
Exactly. Cash is a tool for defense now and maybe soon a tool for offense.
This really emphasizes that point about country-by-country selection, doesn't it? Moving away from just assuming developed world debt is automatically safe.
Precisely. You really have to shift your focus now. Look towards politically stable and fiscally sound nations, maybe like Switzerland, and be much more cautious about those with deep political divisions and chronic debt problems. You can't paint with a broad brush anymore.
Okay, let's pivot one last time across the Pacific now, because the U.S.-China trade negotiations, well, the stakes involved here seem so high, they make the European bond crisis look like a minor issue. The sources are calling this the potential big deal. What's the dramatic trade-off being proposed?
China has come forward with, an unprecedented offer, an investment package of up to $1 trillion, with a T, into U.S. infrastructure and manufacturing over the next several
A
years.
trillion dollars, that's staggering.
It is. To put that in perspective, that dwarfs previous foreign investment pledges from Japan and the entire European Union combined. It's a huge amount of potential capital inflow.
Okay, that is truly massive. Now, if I were the Chinese government, I wouldn't offer that much without asking for something pretty major in return. What's their condition? What do they want?
Their condition is pretty straightforward, actually. The U.S. must lift, or at least significantly reduce, the national security regulations that were imposed during the previous administration, specifically targeting advanced technology like semiconductors, and also lower tariffs on components that would be needed for those potential new U.S. factories they'd invest in.
So why is China so motivated to push this deal right now? What's driving them to offer potentially $1 trillion?
Well, it seems driven by their own domestic pain. The U.S. tech sanctions have severely constrained their advanced technology sectors. This deal would relieve that pressure at home. It would also help address their massive overproduction issues by investing abroad. And it could ease deflationary pressures within China by securing new export markets through those U.S.-based factories.
So it's kind of them solving their internal economic headaches by offering this huge external investment.
That seems to be the core motivation, yes.
The U.S. response, though, as you mentioned earlier, seems confusing. We have the Trump administration apparently running a classic good cop, bad cop routine. What are these mixed signals the market is trying to process?
Yeah, it's definitely sending mixed messages. You're seeing simultaneous optimism and some pretty aggressive threats. The carrot, if you will, is Treasury Secretary Scott Bessent. He's one of the lead negotiators, and he's been suggesting a very big breakthrough might happen at the APEC summit in Korea, which is coming up in late October.
And APEC, just for clarity, is the Asia-Pacific Economic Cooperation Forum. So that sounds like a prime spot for a big diplomatic announcement. Okay, that's the carrot. What's the stick being waved around at the same time?
The stick is some concurrent, pretty high-level pressure. President Trump is threatening 100% tariffs on pharmaceuticals from non-U.S. manufacturers. That's one thing. But crucially, there are also reports that administration hardliners are seriously considering imposing 100% secondary sanctions on countries, including China, that buy Russian oil.
Secondary sanction. Okay, that sounds serious and complicated. What does that actually mean for the average investor, or just in practice?
It means we don't just sanction the target country, like Russia. We sanction anyone who does business with the target. Think of it like a global economic blacklisting, almost. If the U.S. imposes secondary sanctions on countries buying Russian oil, China is basically forced to choose. Keep access to the U.S. financial system or keep their Russian oil supply. It massively raises the geopolitical temperature.
And it's designed purely to maximize U.S. leverage in these negotiations.
Almost certainly. Maximum pressure.
So given the size of the potential carrot, $1 trillion, and the, frankly, brutality of the secondary sanctions, what does this environment mean for you, the investor, right now?
It means the base scenario, the sort of middle-of-the-road outcome, that's utterly collapsed. The sources we read really emphasize there's no middle ground left. No gentle compromise for the market to price in.
So it's one extreme or the other?
Basically, yes. Only two extremes seem possible now. Either a massive risk-on rally if a deal is actually struck, imagine trillions pouring into U.S. manufacturing, or a sharp risk-off crash if new tariffs and these secondary sanctions actually hit. We are operating on a binary scale, it feels like. You have to prepare for extreme volatility based on potentially single headlines out of APEC or D.C.
Okay, but wait. Let's say the president does strike this big deal at APEC. Is the volatility finally over then? Or does the political structure here in the U.S. present its own kind of risk?
That is a crucial counter-risk to consider. The sources call it political implementation risk.
Okay.
Even if President Trump strikes a successful deal with President Xi in Korea, political China hawks back in Congress could view lifting national security regulations on tech as, well, a surrender. They hold the power to try and block the deal through legislative means, maybe requiring specific certifications, blocking funding, adding riders to critical bills.
So the risk is that the deal gets agreed upon at the presidential level, but then gets stalled or even killed back here in Washington.
Exactly. It might not actually be implemented, which keeps markets volatile and just prolongs the uncertainty, regardless of any diplomatic handshakes.
That's a fascinating and slightly terrifying layer of complexity. So if we have this huge, possibly unavoidable U.S.-China political battle looming, what are the best kinds of geopolitical hedges? Where can investors look for some insulation?
Yeah, you need assets that are somewhat isolated from this direct U.S.-China trade war battlefield. The recommendations generally point towards U.S. domestic service companies think businesses that aren't heavily reliant on global supply chains or exports-imports.
Okay, more internally focused.
Right. Also, assets in non-aligned developed countries, Japan and Switzerland, come up again here. And circling back to our earlier point, potentially increasing your position in gold. These types of assets tend to provide more stability, regardless of whether the big deal is struck or if new tariffs start flying.
Okay, so bringing it all together, what does this all mean? We've covered political chaos from Paris to Washington to Beijing. Let's try to synthesize the three key pieces of knowledge for the listener. What should they take away?
Okay, three big things. First, political instability, whether it's the French election outcome or the U.S. government shutdown, is now the primary, maybe the overriding driver of market risk, period. It arguably matters more right now than the latest GDP number or inflation print.
Politics first. Got it. Second.
Second, the definition of a safe asset has fundamentally changed. Your portfolio's anchor needs to be, let's say, politically diversified. You have to recognize that sometimes high-grade corporate debt from a stable company might actually be safer than financially strained government debt from a politically volatile country.
Okay, rethink safety. And the third essential takeaway.
Prepare for unprecedented, almost binary volatility driven by these U.S.-China negotiations. Given the sheer size of the proposed investment and the potential tariffs, the market seems structured now for either a massive boom or a major crash. There isn't much room left for gentle middle ground outcomes. So we established today that politics really seems to be setting the price for almost all assets right now. The final, maybe provocative thought for you to consider is this. We've discussed three really high-impact political variables today. Which one do you think the outcome of the French election, the duration of the U.S. government shutdown, or that sudden breakthrough or collapse at the APEC summit, which one will be the catalyst? Which one will cause the next truly global systemic shift in asset prices?
Great questions to ponder. Thank you for walking us through these really complex global risks with such clarity today. Don't forget to subscribe and hit that like button.